Good evening, everybody. Welcome to our revision presentation, our revision webinar, covering the OCR 585 revision stimulus on the global economy paper. And tonight we're going to be focusing on extract 3, which looks at primary product dependency, the progress that Zambia has made in terms of human development, and some technical stuff relating to something that's quite specific to the Year 2 syllabus, namely the terms of trade. So welcome. I hope the session is going to be useful for you as part of your overall revision. I'll be focusing in particular on 3 aspects of this extract. One is the idea of human development and the extent to which Zambia has harnessed the natural resource wealth and turned it into genuine sustainable development progress. Secondly, we're going to be focusing on the idea of the natural resource curse and what Zambia could do perhaps to avoid it going forward as the terms of trade move against Zambia in the next few years perhaps. And thirdly, a little bit of a focus on the mining sector, which I suppose is pivotal to the whole debate about whether FDI into Zambia is good for their growth and good for their development, and crucially, the overall extent to which the government should be nationalising the state assets, the mining assets that Zambia has. So welcome to this revision session. We're going to make a start, and hopefully if you've got some notes to hand and the extracts to close by, you'll be able to add in some really good stuff over the next half an hour or so. Okay, so the extract 3 is really an attempt to get you to think a lot about the significance of the price at which a country exports its main commodities, and the real emphasis of this extract, I think, really is about the terms of trade and the net cost and benefits of Zambia being a major copper exporter. So approximately between 2/3 and 3/4 of Zambia's export revenues at the moment come from copper. Hopefully that will change over time. The key question is whether Zambia has been able to use that money successfully to promote development. You may be familiar with the work of Professor Paul Collier, who's written a book called The Bottom Billion and also one called The Plundered Planet. He's probably the most influential development policy economist alive today, and he's done a huge amount of work on the barriers to growth and development in lower and middle income countries. He's actually identified something called the development trap, and he thinks there are essentially 4 of those traps: conflict, civil war, obviously being a major one, an over-reliance perhaps on natural resources, primary commodities, which is going to be our focus in this session, the limitations and the constraints of being landlocked. And this map, of course, will give you a clue to who the landlocked countries are in sub-Saharan Africa, especially if you have bad neighbours. And crucially, fundamentally, the whole issue about the quality of government, the quality of institutions, the ways in which sometimes extractive elites can take most of the revenue from natural resources, leaving the vast majority of people in relative poverty. So for the exam, I'd be familiar with the idea of development traps and think about the extent to which Zambia can overcome these traps going forward. That could be a focus in particular of your 20 marker. This next chart comes from the work of my good friend Cesar Hidalgo, who is a brilliant physicist at MIT, and he plots all the trade of every country in the world and looks at what they export and what they import. Now, this is a wonderful chart for Zambia because it shows how reliant they are if we just focus on goods, on the export of refined copper, basically raw copper that's been processed a little bit, and cobalt. Add those figures together, you get over 70% of Zambian goods exports come from refined raw copper and cobalt. And they have some other industries as well. They have a sort of a native farming industry, and they could produce some cement and some minerals and things and some gold. But essentially, Zambia is a classic example of a country which is highly primary dependent. If we look on the other side on the import equation for the economy, we see here a much more variegated landscape, much more of a, if you like, a patchwork quilt effect. By the way, every little square, every little area is a particular product. So we can see, for example, in the top left-hand corner that Zambia is, doesn't make any fertilizers. It basically imports them from South Africa. It doesn't make any pharmaceutical products. It has to basically import most of the oil it needs, and the telephones and the computers and the delivery trucks and the pipes and the wiring. So interestingly, 2% of Zambian exports are postage stamps, imports, sorry. So Zambia is essentially a net exporter of primary products and a net importer of manufactured goods, fertilizers, what have you. It's a classic diagram which is pretty common, pretty familiar if you've studied African economies. So the starting point for extract 3, everybody, is that Zambia is a net exporter of copper, and it's essentially dependent on that industry. Extract 3 then goes on to look at the extent to which Zambia has made development progress over the last 10, 12, 13 years. So figure 3.1 provides you some data on there. The exam board have issued an erratum notice. We spotted some mistakes in the data, naughty OCR, but anyway, they've now produced a corrected exam paper. So when you're revising, make sure you're using the latest version of the hard copy of the pre-release. So what does figure 3.1 show? It shows basically a snapshot of the 3 elements of the Human Development Index, the HDI. Education, health, per capita incomes, they all have a 1/3 weighting in the HDI measure. And there's some evidence, some clear evidence here that Zambia has made some fairly significant progress in some aspects of development. Of course, some of the data is missing. We're not told what the inequality data is. We're not told what the extreme poverty data is. But there's some evidence here, in particular, the increase in life expectancy, a primary school enrollment rate of more than 100%. Clearly, a lot of adults go back into primary school beyond the primary school age. And some improvements post-2007 in GNI per capita, gross national income per head of population, measured in dollars, adjusted for purchasing power parity. So Zambia has made some improvement, and this chart, which should be coming up for you now, I think really tries to capture that for you. Malawi featured in a previous extract in the 2016 release, and what I've done here is I've plotted GDP per capita. It's essentially the same as GNI for both countries, so don't worry about that. PPP per capita, GDP per capita, PPP in dollar terms since 1980. And I just think the take-home point from this chart, this slide, is the fact that Zambia has essentially accelerated away from Malawi. Don't forget, Malawi borders Zambia. And if you follow the blue line here, Malawi has made very, very limited progress in lifting its per capita income. It remains one of the poorest countries in the world. Whereas Zambia has done significantly better. It's now a lower middle income country. And if you follow the red line here, or the deep orange bit, it's actually overtaken the average for sub-Saharan Africa. Okay, so in that sense, there's some good news here. Zambia has made substantial progress in terms of per capita incomes. The big question, the kind of 20-mark style question, is which policies, which strategies might be best and most effective in sustaining that kind of progress, that growth and development progress for a country such as Zambia. And we'll return to that if you log on to future revision webinars on future extracts. Just staying with, for a few minutes, just staying with the long-term development perspective. I think it's quite important to understand what has happened to Zimbabwe before 2000. If you look on the second column here, life expectancy at birth, it collapsed during the 1980s and early 1990s, largely on the back of a horrific HIV/AIDS epidemic, costs hundreds of thousands of lives and caused the life expectancy to absolutely collapse to 41 in 1995. Then it stabilized, and it's now rising again quite substantially. So I think it's quite important to understand the historical context here. Zambia is widely regarded as one of the big success stories in terms of progress in addressing HIV. Interestingly, a lot of the medication that is provided, the antiviral drugs and things, are provided by the mining companies themselves. They've helped to fund the provision of those drugs. Now, when copper prices fall, that has a consequence for their ability to continue doing that. But the backstory here is that Zambia's GNI per capita has grown. In real terms, it's grown. It's actually gone up 7 places in the HDI rankings. And it has an HDI value in 2013 of 0.56. If one tries to put that in the context of what other African countries have done, this chart will help us. On the y-axis, we've got the change in the GNI per capita index bit of the HDI. And on the x-axis, from left to right, the change in the health and education index, 2 of the 3 components. So countries that appear bottom left, Eritrea, Swaziland, Madagascar, they have seen the least improvement in human development outcomes. Okay, countries which appear top right, Ethiopia, Angola, Tanzania, they've done significantly better of sub-Saharan African countries. And Zambia, to give it credit, largely on the back of health progress and income progress, Zambia has outperformed the average gain in 2 of the 3 HDI outcomes. Now, the extent to which that is due to copper prices and mining and what have you is open for you to question and discuss. But the evidence is clear. Zambia as a country has made significant progress. Just while we're on the HDI, it's worth revising perhaps for a minute or two some of the limitations of the Human Development Index. So hopefully all of you are familiar with what the HDI seeks to measure. It's essentially a composite indicator of living standards and of development progress, basic things, education, health, and income. Of course, the HDI on its own is an average and it's a composite, and it tends to miss out some of the qualitative aspects of life and things such as cultural identity, democratic freedom, employment security, gender opportunities, basic human rights, for example. So qualitative aspects tend to be ignored by the HDI. If you like, the well-being aspect as opposed to the narrow welfare aspect. The HDI, as normally published, takes no account of income inequality. And there's a line there that I put in there: inequitable development is not really human development. The purchasing power parity values that we use to do some calculations, sometimes they can be out of date. Exchange rates can be out of line with purchasing power parity, and finding the right basket of goods and services to use to make the calculations can be very difficult from developing country perspective. The HDI now has some brother and sister calculations. So there's now an income inequality HDI, and there's also a multi-dimensional poverty HDI index. Now, if we take the loss of human development score due to inequality for sub-Saharan Africa as a whole, it's 23%. For Zambia, it's 34%. And that, I think, alerts you to a major issue that's relevant to extract 3 and also to extract 5. Zambia has one of the highest levels of income inequality of any sub-Saharan African country. And that's, I think, has to be a major focus of your revision ahead of the exam. Just again, thinking a little bit about what has happened on the HDI for Zambia. Some of this data appears in your extract. This slide I've put in because it's quite important. It shows the disconnect or the discrepancy between expected years of schooling, and assuming schooling starts at the age of, let's say, 4 or 5, the expected years of schooling, so you might be thinking of finishing school at 16 or 17, and the mean actual years of schooling, which of course are much less. In fact, they're less than half. So typically a lot of Zambian children will leave school at 11 or 12 and not move on to secondary education. I'll come back to that in a second. So there's a big issue there. Notice also the bit in red, that education spending in Zambia is only 1.35% of GDP. This on the day when Liberia as a country has privatized completely its education system to a US private sector education provider, I think is a relevant and interesting figure. So Zambia spends relatively less of its GDP on education compared to healthcare. Is that something you can address in a 20 marker as part of your discussion on the supply side for Zambia in the exam? Perhaps that might be worth thinking about. Certainly the pupil-teacher ratio is very high. All kinds of debates about quality of teaching. The education system, of course, has to cope with hundreds of thousands of AIDS orphans, which is a major issue for them. And the economy as a whole has a 40% plus child labour ratio, which is, of course, staggeringly high, in many ways appallingly so. In terms of health indicators, we've mentioned that Zambia has made substantial progress in lifting life expectancy, although it's following a U-shape, if you like. Again, there's some good news here that Zambia has basically made significant Millennium Development Goal progress in most indicators. In particular, they've brought down HIV prevalence rates, particularly for younger people, below 5%. That's significantly important. But notice in red here how much more they spend on healthcare as a share of GDP rather than education. I think that's quite a significant difference for a country with a relatively low per capita income. One of the issues not covered by the data in extract 3, and therefore something that you could perhaps take into the exam to maybe throw in as an evaluation point, is of course the HGI figures that the exam board have given you don't really tell you anything about the gender inequalities in the country such as Zimbabwe. Zambia has a pretty high gender inequality index, and here are some of the data. I mean, picking out one or two little bits for you, that only 25% of women have a secondary education, compared to 44% of men. The labour force participation rate is quite high in Zambia, although not in mining. Only 10% of the mining workforce is female. The main reason for the high labour market participation for females is the very heavy dependence on subsistence farming in rural areas. But I think from an exam point of view, everybody having a sense and a feel of some of the gender inequality data is helpful to kind of supplement the stuff you're given in extract 3.1. And again, just digging beneath the data a little bit more, the red here shows GNI per capita for Zambia. You'll be familiar with that number there, just a tad under $3,000. Their GDP is basically the same, and that will become apparent when we look at remittances in extract 4. Zambia is allocating around 23% of their GDP to investment. The average for sub-Saharan Africa is around, for emerging Asian economies, is around 31%. So you could make an argument for saying that Zambia needs to lift their investment rate, not just in mining, but in other sectors as well. We'll come on to some of the issues to do with banking when we get onto extract 5 and debt and things. But in particular, look at the midway down this slide, the percentage of the Zambian population living below $1.25 a day, PPP. That is the official, at the moment, the official poverty line, extreme poverty line in the world. It's nearly 3/4 of the population. And again, that tells you something quite significant, that Zambia has made tremendous progress in lifting per capita incomes and achieving better health outcomes, but the majority of the population are still poor. And why is that the case? Because inequality is so high. Now, there are various measures of inequality. I'm not going to take you through all of them tonight. Some people look at the quintile ratio, the richest 20% income divided by the poorest 20%. Some people love the Palmer ratio, where you take the income of the richest 10% of the population and you divide by the income of the poorest 40%. You get a figure of 4.8. The standard measure of inequality for most countries is something called the Gini coefficient. Sometimes it's expressed from 0 to 100. Occasionally it's expressed from 0 to 1. My chart shows 0 to 1. 0 is perfect equality. 1 is total inequality. A figure for Zambia of 0.57, 0.58 is high. In fact, it's the 6th highest inequality level in the world. In terms of Zambia's financial flows, so Zambia is particularly dependent on primary products. It has a high rate of exports of copper, for example. Trade to GDP ratio about 83%. That's quite high for African nations. They've received significant foreign direct investment of approximately, in 2014, approximately 10% of their GDP. But actually private capital flows in 2014 were leaving the Zambian economy. So there's some evidence, for example, that private investors were starting to take out some of their previous investments and their previous dollars out of the Zambian economy. And some people are claiming that is the result of the switching of tax regimes for mining. The government couldn't quite make its mind up what it was going to do with mining assets. And also the fact that the Zambian currency is really quite weak at the moment, and investors getting nervous about holding on to a very weak currency. So the next section of extract 3 refers to the terms of trade. Now, for some students, this is very dry, and I can appreciate why that is the case. But it's an important concept, and it's one that's particularly relevant to Zambia, so it's worth our while just spending a few minutes on it. In very simple terms, the terms of trade is, if you want to explain it this way, it's how many exports you have to sell to buy a given quantity of the imports you need to buy. So, for example, how many tons of copper would Zambia have to sell to buy the wheat or the medications or the oil which the Zambia needs for its economy? That's essentially the idea of the terms of trade. And there's a formula for measuring it, which is a weighted index of export prices divided by a weighted index of import prices. So we'll come on to the data in a second, but essentially it's what is Zambia getting for every ton of copper, and what can, as a result of that, from the dollars it gets, what can it buy in terms of imports. Now, for most of the time period over which the extract covers, from 2001 through to 2012, for most of this 10 or 11 year period, the terms of trade were moving pretty decisively in Zambia's favor. Here's the chart. I'm sure you have it in front of you if you've got the extract close to hand. Figure 3.1. You can see that the Zambian terms of trade climbed very sharply, in particular from 2002 to 2006. In fact, they more than doubled if you're choosing the index base of 2000 of 100. So Zambian terms of trade doubled. Now that is a hugely significant increase. Then they fell back again because, of course, the world went into a recession. The price of copper fell very steeply. The Zambian economy is susceptible to these shocks, but they didn't fall back to the level they were at before. They fell back to 160. Then copper prices went up again before tailing a little bit back off again in 2012. So the takeaway point from this slide is that the Zambian terms of trade improved with a volatile component. They improved significantly. Okay, why? Well, because the price of copper, which is Zambia's main export, was also following a very similar trajectory. And hopefully you can see the link between the price of copper, which is not given to you in the extract 3.1, and the Zambian terms of trade. Now, Zambia, if you've done your microeconomics and economics of perfect competition, Zambia is essentially a price taker in world markets. I mean, Chile is the biggest producer. Zambia has about 4% of the world market. So Zambia doesn't set the price of copper. Basically, copper mines are price takers. They do as well as they can at the prevailing world price. So the terms of trade for Zambia pretty much follow the world price of copper. You'll see, I've just put the copper price on the left-hand side here. You'll see that the copper price was following that strong upward trajectory. Then it dipped in 2008, then it went back up again. But in the last 2 or 3 years, since the extract was published, or since the extract data came to an end, the last 2 or 3 years, and this is really important, fellas, the price of copper globally has been falling very sharply, and hopefully you can see that in your in your chart on the left-hand side. So what is happening now is that the terms of trade for Zambia are deteriorating. They're falling. They're moving in the opposite direction to the chart that you have in your stimulus materials. Well, you might be thinking to yourself, why does that matter? What's the significance of a fall in the price of copper for a country like Zambia? And this, I think, could well be an issue that you might have to analyze and evaluate in your exam. If the price of copper falls, then clearly there's a direct effect on the value of exports. So the value of X will fall, that feeds straight away into a fall in aggregate demand, and clearly causes the Zambian growth rate to dip. Zambia has a growth target of 7%. They grew last year by about 5 or 6%, and this year some people reckon they'll only grow by about 3%. There's no way you can grow at 7% when the price of copper is falling as steeply as it is. So there's a growth aspect. Secondly, there is a balance of payments aspect. Because it's their major export, their sales of copper are falling, the value of their output is falling. Zambia is now running quite a significant current account deficit, and that means their foreign exchange reserves of dollars and yuan are starting to ebb away. Some people suggesting they may run out of foreign currency at some point. Fall in the price of copper is also causing significant depreciation of their currency, and that's leading to a spike in things like food prices and the cost of essential raw materials. Inflation in Zambia is already more than 10%. Some people think it's closer to 20%. And the only saving grace for Zambia this year is the fact that the price of oil is so low. It's kind of helping to offset the exchange rate fall. Copper prices falling are also causing many thousands of jobs to be lost in unprofitable mines. Some mines have closed. Some mines have been mothballed because the price of copper is below the shutdown point. So you could bring in the idea of cyclical unemployment. And if those mines stay closed, to what extent that's going to cause structural unemployment in Zambia. Always good to bring in some concepts such as the multiplier effect. If there are fewer jobs in mining, if wages are falling, that has a knock-on effect in supply chains. Crucially, Zambia, of course, does rely on tax revenue, particularly from mining. So that's falling, and Zambia is now running a sizable budget deficit. They may need to go to the IMF. But also I think it's great to think about the social dimension of this, not just the economics, that a lot of mining companies have subsidized HIV medicines. That's under threat. And of course, the copper mining closures having a significant effect again on inequality. So the terms of trade is a fairly dry concept, but actually it's one that matters, and it matters a lot for a country like Zambia. What I've done here is I've just updated your extract, not to show off at all, but just to confirm to you that since 2011, you saw the terms of trade were dipping, and indeed they have fallen. They're now back at 170, which is where they were in 2009. Terms of trade in Zambia have fallen by about a third in the last 4 or 5 years. And one of the consequences is that Zambia has gone from running significant current account surpluses, external account surpluses, which are shown in orange here, to running a deficit now. Zambia is now running a current account deficit, first time since 2008. And you can see the blue line as well, that the size of their trade surplus has also come down quite sharply. Extract 3 also focuses on the mining industry. I just want to spend, if you'll bear with me, about 5 minutes or so just thinking about some of the issues to do with mining. There are many of them contained in this extract, and I'm sure you'll go through the fine detail with a tooth comb ahead of the exam. But clearly, what are the big issues here? The big issues are who should own the mines? Should it be private sector? Should it be the state? And whose interest is that decision made? How best should the mines be taxed in terms of harnessing the resource rents from what lies beneath the economy? How should they be taxed? And crucially, does foreign investment in Zambia, in mining in particular, does it actually benefit the economy as a whole? There's a little bit of technical detail here. So in extract 3.1, they talk about tax avoidance by the likes of Vedanta and Glencore and transfer pricing. So transfer pricing is highly topical. Starbucks and lots of companies, Google, are being accused of this. That transfer pricing is when a company operating in a particular country invoices a parent company for a particular cost. So Starbucks in London, for example, every cup of coffee, there could be a license, 25p per cup of coffee, that goes to Starbucks in Ireland for the right to sell Starbucks coffee in London. And of course, the profits tax in Ireland is less than the profits tax in the UK. So essentially, Starbucks, through transfer pricing, is shifting its profit from the UK to Ireland. So that's transfer pricing. Tax avoidance is just where companies find loopholes and they maybe misreport how much copper they've produced or what their revenues are. Lots of companies very cleverly try and find these little tax reliefs and tax loopholes. And there's a big debate in Zambia about how much that's been happening. So the Zambian government is thinking of nationalising the mining industry. It's tried various things. It's suspended copper exports. You might get a supply and demand question on that. And it's brought in some mining tax reforms to try and get the right mix of taxes. I'll give you an example of that in a second or two. Just want to say a little bit about the mining industry in Zambia. I think it's quite important to have some context here, because context helps the evaluation in your 20-year marker in particular. First point to make is that mining as an industry has a very long lead time. The elasticity of supply of copper from a new mine is very low in the short term. It takes between 5, 7, 10 years from exploration to the copper being extracted. And there are big sunk costs associated with setting up a new copper mine. So foreign investors have big sunk costs, big fixed costs, uncertain revenue streams. And so therefore the risk factor for foreign investors investing in a country like Zambia is pretty high, even before you start to think about exchange rate risk and tax risk, and also the risk of nationalisation. So I think that's worth bearing in mind. A foreign investment is not a risk-free decision, and other countries in the world produce copper. Second point is that Zambia's copper mining industry is actually almost like a dual economy. It's a heterogeneous economy. Most of the old mines in the old copper belt, they have very high extraction costs because most of the cheap copper has already been extracted. They're very labor intensive. And if the price of copper falls, those mines make a loss pretty quickly. So they're unlikely to get much more new investment. The new mines in Zambia along the northwestern province, they're open mine pits. They're very easy to extract using advanced capital equipment, heavy duty machinery. So therefore they're more profitable at any price, but they don't create as many jobs. So it's a capital intensive industry as opposed to a labor intensive industry. I think that might be worth thinking about in terms of your evaluation. How can a government generate the revenue from mining? It can charge a royalty on the value of output. It can charge tax on the profits. And of course, it can charge income tax on the wages of people employed. It's finding the right mix of tax that the Zambian government has found quite hard. When mines were nationalised in 1972, the record suggests that output fell quite sharply, although the price was declining at the same time, and Zambia's share of the world economy of copper production also fell, as you can see from this chart. Since the mines were privatised in 2000, copper production has increased significantly. Look at the grey histogram there, and Zambia's share of world output has increased to around 4%. So would nationalisation bring back another decline, or would it be a better way of harnessing the natural resource wealth that lies beneath the ground in Zambia? And I suppose that extract 3 is essentially this big debate about who actually benefits from FDI into mining. Who are the gainers and who are the losers? And this slide, it might be worth reading through this later on if you want to press the pause button on the presentation at this point in the future. do that because there's quite a little detail here. But the debate about FDI in Zambia is about jobs, it's about wages, it's about generating the foreign currency. So there's lots of scope for ADAS diagrams and that kind of stuff. But also it's crucially about the environmental aspects. It's about the social welfare aspects in particular. So the aspects of pollution, the aspects of the fact that the Zambian copper industry takes up a huge percentage of Zambia's hydroelectric power, takes up a lot of their water, but employs relatively small number of people in the country. So these are big debates. These are huge issues. I'm sure you'll be trying to revise them before the exam. Just a couple of years ago, War and Want, it's actually more recent than that, 2015, so they published a pretty coruscating report on the Zambian multinational corporations, and they accused the likes of Glencore and others of depriving the Zambian government of up to $3 billion a year in tax avoidance. If you're looking for a particular perspective on it, it might be worth checking out their report. So this turns us to the final bit of our revision presentation tonight, and that's to think about the idea of the resource curse. Essentially, we've said that Zambia is highly dependent on copper and cobalt, and there are many countries around the world who are in a similar position in that sense. They are primary sector dependent and at risk of something called a natural resource curse. What is the resource curse? The resource curse is that countries that are rich in natural resources often actually have slower economic growth and poorer development outcomes than countries which are less resource intensive. And Paul Collier is quoted there on this slide. Now, why might there be a natural resource trap or a natural resource curse? All kinds of reasons. Fundamentally, natural resources are often a source of civil war or corruption, certainly political conflict. Politicians like to get their hands on the extractive wealth, and there have been many examples of civil wars linked to the extraction of natural resources. Second problem, of course, is that countries such as Zambia are highly exposed to global external shocks. A world recession, for example, which causes the price of copper to fall. And in these countries, typically there's a very limited welfare safety net. A lot of farmers and consumers and households, they don't have insurance, they have limited savings, pensions are a luxury few can afford, and the state doesn't take enough tax revenue to provide some sort of welfare. So their economies are more susceptible to economic shocks. Thirdly, there's an environmental aspect, an externalities issue here in particular, that countries may over-extract their resources too quickly before a country is able to really harness the wealth properly. So a country might run out of the resource effectively, the so-called tragedy of the commons, before it's reached middle income level or even higher. Now, some countries have avoided that. One could point to countries like Botswana as an example of a nation that's lifted its per capita income on the back of its mineral wealth. The fourth point, of course, is really focused on OCR. The idea that if you're an exporter of a major commodity and the world price goes up, your export revenues soar, everything looks good, but then the currency rises also as a result. And this is called the Dutch disease effect. And as a result, although copper mines might be doing particularly well, farmers can't sell their goods overseas, or light manufacturing businesses may suffer as a result. The big danger with wealthy natural resources is that too much of the investment gets skewed into mining and extraction, and not enough money goes into other industries. The base of exports is too narrow. It's worth reading some economists on this, and I'm particularly fond of people like Paul Collier and Joe Stiglitz, who've done some great work on this. I like this quote, by the way, on the right-hand side from Joe Stiglitz, that resource-rich countries, and Zambia is one, often don't pursue sustainable growth strategies. They don't reinvest their resource wealth sufficiently well to make those long-term rents for governments. And of course, corruption is right at the heart of that. So what could a country like Zambia do to overcome the natural resource trap? I think this is where extract 3 can link well into extract 5. So the terms of trade could be a much more of an analysis comment question, whereas the natural resource issue, the FDI into mining issue, sounds to me a little bit more like a 20 marker. You know, discuss the supply side strategies or the economic policies that could best sustain growth and development in Zambia. Well, for that to happen, Zambia has to overcome the natural resource curse. How can it do it? It needs better institutions. I mean, it is a functioning democracy, but clearly there's more they can do to increase the transparency of their resources. Some countries are using the resource wealth that they get to create a sovereign wealth fund. So countries like China and Norway and Qatar have built up big sovereign wealth funds with their export revenues. So they use that to fund education and infrastructure. A country like Ghana, which is quite interesting, worth looking at, they've used a stabilization fund. So Ghana's resource wealth, some of it goes into a fund, which if the economy goes into a slowdown, they can dip into like a buffer stock and spend some extra money on it, maybe a cash transfer to households, or maybe some extra investment spending. So quite a few countries that are resource rich are using stabilization and sovereign wealth funds. Could that find a way into your exam answer? Crucially, governments have to find ways of generating the tax from the natural resources, turning a resource rent into a salary for a better quality teacher, or a new hospital, or better roads, or improved telecommunications. It's the classic, create the resource revenues, tax them appropriately without causing the disincentives, and hopefully generate capacity and capability on the supply side. But fundamentally, what Zambia has to do in the long term is it has to diversify. It has to move away from its narrow focus on extraction and more extraction towards processing, manufacturing, light manufacturing, move more towards tourism, perhaps some ethical tourism, what have you. These are industries which potentially have much higher value added. They'll give the Zambian economy a much wider base of exports upon which to base its future growth. So the takeaway point from this slide is that there are lots of different strategies that countries could use and have used to achieve or reduce the risk, if you like, of a natural resource trap. So that has been quite a detailed, quite a focused, hopefully, look at some aspects of extract 34585. Thank you for working your way through it, and if you need to go back through it again, we're going to put this video on YouTube for you to take some extra notes. There's lots more resources for 585 on the Tutor2U website. Just go to tutor2u.net/economics and you'll find them there. Just type in 585 into the search engine, you'll be fine. If you want to keep the conversation flowing on this 585 pre-release case study, or if you want to ask me any revision questions at all on economics, I'm on Twitter at tutor2jeff, and I'm really happy to answer your questions as we head towards the exams. Thank you for being with us this evening. Take care, good luck with your revision, and see you again sometime soon.